Okay, let's dive in. Today, we are not talking about, broad, airy market trends. We are pulling up a very specific ledger, a deep dive into the sales data from the absolute heart of the Kampala alcoholic beverage market.
And it's incredibly specific. We're focusing on the central business district during what is probably the busiest time of year, the first week of December 2025.
So what's the source here? This isn't total market sales, right?
No, and that's a key point. This is a market analysis report, and it's built on granular sales figures from a select group of clients. Think of it less like a census and more like a high-powered X-ray. It gives a really strong directional view of what's happening.
Got it. So our mission today is to unpack this ledger. We want to reveal the real market hierarchy, understand why some parts of it seem so unstable.
And most importantly, pinpoint the massive commercial opportunities, the ones being created by consumer trends and, frankly, some pretty big gaps in the supply chain.
If you want a shortcut to understanding where the money is, this is it.
Yeah, we're moving past stories and into the hard numbers, but before we get buried in all the percentages, maybe we should quickly define a couple of technical ideas that really shape this whole market.
It's a good idea. Let's start with pricing. When we see the term price index in this report, what are we actually looking at?
Just think of it as a measure of markup. A price index of 100 means a channel sells at the average market price.
Okay.
So if a channel hits, say, 135 on the index, it means their average selling price is 35% above that market average. It shows you where people are willing to pay a premium.
For convenience, for service, for that luxury feel.
Exactly. And the second big concept is volatility. It's all over this report.
Right. And it's measured as a standard deviation. It's basically a measure of predictability or risk.
That's it. Low volatility means steady, reliable daily sales. But if a channel has, say, 177% volume volatility, yeah, it means their sales swing wildly. They're either selling nothing or they're pushing massive bulk orders. It's the difference between retail and, event-driven commerce.
Perfect. With those definitions locked in, let's jump straight to that big picture, the market hierarchy. The data shows this absolute split where different channels are doing completely different jobs.
It's crystal clear. There's a huge difference between channels that generate revenue, what we call value, and channels that just push tons of product, which is volume.
And the undisputed king of value is
The bar and restaurant channel. It's not even a close race.
the numbers are pretty stark. They account for 26.01% of the total sales value in this data. Plus, they're a strong volume driver too, at over 21%.
Right. The report calls this channel the market's primary showroom for brand discovery. And that feels right. You go out, you try a new premium spirit, and that experience sticks with you.
It sets the trend. And it defines what a premium price even is. Okay, so if bars are the showroom, what's the engine room? Who's moving the product?
That would be the wholesale sector. We're tracking two main types here, the distributor and wholesaler and the merchant wholesaler.
And together, they're the volume engine.
By far. In fact, they're tied. Each one individually accounts for an identical 20.97% share of total market volume. They are the absolute backbone of bulk sales.
So what's the subtle difference between them? A distributor and wholesaler versus a merchant wholesaler.
The report suggests it's about focus. The distributor and wholesaler seems to handle bigger initial stocking orders for, say, new hotels and maybe more premium imported stuff.
Oh, the merchant wholesaler.
They seem to be about speed, high-velocity movement of popular, accessible brands. They're servicing smaller shops or big, less formal events.
And this is where the rubber meets the road, right? The pricing spectrum.
Yeah.
Because these different roles lead to these completely polarized pricing strategies.
This is the real aha moment in the data. You have your premium channels that command these huge markups. Tier 2 supermarkets, so your more specialized, high-end grocers.
Yeah.
They have a staggering 135.71% price index. They are consistently charging over a third more than the average.
So they're selling trust and convenience at a premium. And the mobile stockists are right there with them.
At 135.13%. Exactly. These are high-margin, specialized players. Now contrast that with the channels built for volume.
You mean the value channels? We see liquor store chains with a price index of just 59.28%. That's remarkably low.
It is. And Tier 1 supermarkets, the big general ones, are even lower, all the way down to 44.27%.
So the retail market is completely split. Tier 2s is for premium discovery. Tier 1 and the chains are for value. They sacrifice margin for pure speed.
Pure speed and volume. It's a perfect split.
Which leads us perfectly into our second segment, stability and volatility. Looking at the raw data, the wholesale sector just looks chaotic. but the report says this volatility is a feature, not a bug.
That is the most crucial distinction. If you look at the raw numbers, the volatility for wholesalers is off the charts. Distributor and wholesaler has 177.40% volume volatility.
That's almost double the average volume swinging in either direction. How do you even manage inventory with risk like that?
You manage it by understanding their model. Their business is not built on steady daily foot traffic. It's built on large, infrequent bulk orders.
Like stocking a brand new hotel.
Or fulfilling a massive government tender for a holiday party. They might sell almost nothing for days and then move an entire truckload for one wedding.
It's event-driven. So that extreme volatility stands in sharp contrast to the consumer-focused channels.
Oh, completely. It's night and day. Take the restaurant and cafe segment.
How stable are they?
They're rock solid. The most stable in the whole analysis, just 6.03% volume volatility. It's incredibly predictable.
So even if they're small by volume, they offer a reliable, low-risk sales stream.
Absolutely. It's consistent daily sales. And the liquor store chains are similar. They show pretty stable demand, around 36% volatility, which is way, way lower than their wholesale cousins.
Okay, but what about price volatility? We're seeing big swings in the bar and restaurant channel. Why are their prices so dynamic?
Yeah, bars and restaurants are at 136.59% price volatility, and mobile stockists are even higher. This isn't just inflation. It points to a really dynamic product mix.
Meaning one day it's cheap beer, dropping the average price, and the next day it's a high roller event, moving top-shelf champagne.
That's exactly what it implies. They are constantly catering to different demands, running promotions, capitalizing on events. The price depends heavily on what day you walk in.
Let's shift from the market mechanics to the actual products, the juice, so to speak. What categories are really fueling this engine?
It really boils down to three categories. First, wine is the highest volume category, period, and its performance is almost entirely driven by the wholesale sector.
Confirming their role as the bulk movers.
Completely. The merchant wholesaler alone is responsible for 13.71% of all market volume. Add the distributor and wholesaler, and you see the whole picture. They're moving wine for everyone.
Okay, so that's volume. What about value?
That's whiskey. Whiskey is the primary driver of market value. It's the luxury cash cow, especially in those premium retail outlets like the Tier 2 supermarkets.
And in the bars and restaurants, I assume.
For sure. And then you have rum, which is sort of that strong mid-range volume driver with broad appeal across a few different channels.
What's really fascinating, though, is how a single brand, even a single product, can align with a channel strategy and just dominate.
It's actually unbelievable. The concentration is immense. We are talking about one specific product, one XCU, sold through one channel that accounts for almost 9% of the entire market volume in this data set.
Get out. What is it?
Okay, listen to this. Robertson Natural Sweet Red 750 milliliter, sold through the merchant wholesaler, accounts for an incredible 8.87% of total market volume.
Wait a minute. Nearly 1 out of every 10 units sold in this entire analysis is that one specific bottle through that one channel.
One SKU. It is the undisputed volume king. It perfectly defines that wholesaler's role as the engine for popular, accessible wine.
That must create a massive barrier to entry for smaller brands. How do you even compete with that?
You don't fight them on volume. You have to focus on the value channels instead. The bars, the premium supermarkets where discovery and margins are the goal.
That makes sense. So let's look at the value side. Which premium brands are doing the heavy lifting there?
It's Johnnie Walker Black Label 1L. That accounts for 5.60% of total market value, and it's the key to the Tier 2 supermarket strategy. It validates their high price index.
People will pay for the certainty that they're getting the real thing.
They will. But here's an interesting one. The distributor and wholesaler, that volatile, volume-focused channel, one of their top value drivers is high-end champagne.
How does that work?
It goes right back to that event-driven model. Veuve Clicquot Brut 750 milliliters is a top driver for them, also 5.60% of total value. They're not selling it bottle by bottle.
They're fulfilling a massive order for a wedding or a corporate launch.
Exactly. One or two huge transactions that make their numbers swing. Meanwhile, a brand like Moet & Chandon is critical for the ongoing luxury experience in bars and restaurants. The data shows exactly who is selling what and why.
Which brings us to the most actionable part of this whole deep dive. The context, the why. Why was this week in December so active, and what does it tell us about where the market is going?
December in Kampala is peak season, absolutely. And the activity, especially that wholesale volatility, is driven by powerful cultural factors.
Okay, so give us that narrative. What are we talking about?
First, you have the peak of the wedding season. That's huge. And it's coupled with traditional introduction ceremonies, the Kwanjula. These events require massive bulk orders.
Fueling that wholesale engine.
Absolutely. Then add on all the end-of-year corporate parties and new places racing to open before the holidays. It's a perfect storm of demand.
That makes total sense. But the underlying trend here, the big insight, seems to be this consumer shift towards premium brands.
It is. The field observations were unambiguous. There is a huge, consistent demand for globally recognized premium brands. People want to buy them, and they have the money.
And this desire is creating the single biggest insight in the report.
The massive supply gap.
A quantifiable gap between what people want to buy and what's actually on the shelf.
Yeah.
This points to a major supply chain problem.
It's a huge deficiency. The report literally lists the products people were asking for that were just out of stock. This is the most immediate opportunity. If you can fix this, you win.
So what's on the list? What are people looking for?
For spirits, it's global heavyweights. Jack Daniels, specific ages of Glenlivet and the Macallan, Grant's Triple Wood, expressions of Johnny Walker like Double Black, and Jameson.
Wow. Those are flagship products to be out of stock for, especially during the peak season. That points to some fundamental forecasting issues.
It does. And it's not just spirits. You see it in liqueurs and wine, too. Amarula cream liqueur, Moet and Chandon, and even really popular mass-market wines like Four Cousins and specific Robertson types.
The strategic takeaway seems undeniable then. The immediate path to growth isn't about marketing new brands. It's about securing a reliable supply of the brands people are already demanding.
The demand is there. The supply chain is just leaving money on the table. The market is thirsty, and the shelves are empty.
Okay, let's bring this all home. What are the 3 big takeaways for you, our listener, from this deep dive?
First, I think, is that structure is everything. The market has this crystal clear segmentation. Bars and restaurants are the value engines, the showrooms. Wholesalers are the sheer volume movers.
Second, volatility isn't always a bad sign. In the wholesale channel, those extreme swings are a feature of their bulk event-driven model. It's a strategy.
Right, and that contrasts so sharply with the steady, predictable demand in the smaller consumer channels.
And finally, the big one. The move towards premiumization is real, and it's creating this massive, quantifiable supply gap. Fixing the gap is the single biggest commercial opportunity in the market today.
The whole market is polarizing. You have high-value, stable channels on one side and high-volume, volatile channels on the other. And the winners will be the ones who can bridge that supply gap for premium goods.
Which leaves us with a final thought to chew on.
Yeah, and it's a broader one. We've seen how these highly specialized distribution roles have emerged in this specific market. So the question for you to consider is this. What other consumer goods markets around the world think electronics, pharmaceuticals, anything complex might be hiding similar specialized roles in their smallest or even their most volatile channels?
Is volatility always a signal of risk, or is it sometimes just the necessary strategy for moving things in bulk?
Exactly. A fascinating thought on how structure really dictates strategy. Something to mull over until our next deep dive.